Level 1 is the beginner investor. You open your investment account for the very first time, and while the screen looks simple, just buy, sell, and moving numbers, none of it actually feels simple. You deposit your first $500. It might not be a huge amount, but it matters to you. As you scroll through stocks of companies you've seen your entire life, you realize something crucial. You aren't just buying a price tag, you are buying a small piece of a real business. That concept takes time to truly sink in. You make your first investment not to trade it for a quick profit, but to hold it and see how it grows over time. Gradually, you start looking at the market differently. You stop focusing just on the price fluctuations and start paying attention to how the company actually operates, how it generates revenue, and why it succeeds or fails. You begin reading articles, reports, and different financial opinions. Soon, you notice a clear divide. Some people are desperately trying to predict the next short-term move, while others are trying to understand the actual business. This becomes your first real decision. What kind of participant do you want to be? At this stage, your financial returns are small, and they almost don't matter. What truly matters is learning how the system works, how markets behave, and how true ownership builds wealth. Investing isn't about reacting to every single change. It's about staying in position long enough to benefit from the growth. Once you understand that, a shift happens. You stop watching every minor movement. You start thinking about the long term, and that is exactly when you move to the next level. You are no longer just learning. You are participating. Level 2 is the retail investor. You invest consistently every single month, not just when the market feels good, and not only when prices are rising. Whatever your budget allows, whether it is $500 or $1,000, you set up automatic contributions directly into your brokerage account. From there, you distribute your money into specific assets with a clear plan. Index funds tracking the S&P 500, sector-focused exchange-traded funds, and a few individual stocks you have thoroughly researched. Your portfolio begins to take a deliberate shape, organized by strategic allocation rather than random guessing. Perhaps 60% equities, 20% ETFs, and 20% cash or short-term holdings. Through this process, you learn what true diversification means. It isn't just about owning multiple stocks. It is about holding assets that behave differently under the exact same market conditions. Eventually, the market drops and your portfolio drops with it. Not just by 1% or 2%, but sometimes by 10% or even more. This is your first real test. Yet you don't panic and sell because you now understand a fundamental truth. Volatility is not actual risk. Selling at the wrong time is. Instead, you continue investing through the downturn, month after month. This disciplined approach is called dollar cost averaging. You aren't trying to time the market. You are steadily building your exposure to it. At this stage, your absolute returns are still relatively small, but your financial behavior is no longer random. It is structured. You actively track your portfolio's total return, cost basis, and allocation percentages. You begin thinking in terms of years rather than days because you realize the goal at this level is not to outperform the market, but to stay invested long enough to benefit from it. Once your portfolio grows to a size where market movements start to represent significant amounts of money, your strategy naturally has to evolve. You are no longer just participating, you are building an asset that actively compounds. Level 3 is the consistent investor. Your portfolio crosses the $100,000 threshold, and that specific number fundamentally changes how you pay attention. A 1% market move is no longer abstract. It represents $1,000. A strong year in the market can add $8,000 to $12,000 to your net worth without any additional contributions. For the first time, your returns feel entirely real. You stop thinking only about how much cash you contribute and start focusing heavily on the power of compounding. Your strategy becomes significantly more defined. You set a strict target allocation, such as 70% equities, 20% fixed income, and 10% cash or alternatives, and you stick to it. You begin rebalancing your portfolio based purely on those percentages, completely removing emotion from the equation. If equities grow too large, you trim them. If they fall, you add to them. At this stage, your focus shifts toward risk-adjusted returns. It is no longer just about how much money you make, but how much risk you are taking to achieve those gains. You closely pay attention to volatility, drawdowns, and how your assets move in relation to one another. Market corrections no longer feel like a crisis. They simply feel like an expected part of the process. You also begin optimizing for taxes, holding assets long enough to qualify for long-term capital gains, and utilizing tax-advantaged accounts whenever possible. At this level, your behavior is entirely consistent. You invest regularly, maintain your allocation, and follow your strategy regardless of short-term market noise. Success here is no longer about picking the next hot stock. It is about executing the exact same disciplined approach over time. Once your portfolio grows large enough, even minor improvements begin to matter immensely. That is exactly when your approach shifts again, moving from simply managing your investments to actively optimizing them. Level 4 is the advanced investor. Your portfolio crosses the $250,000 to $1 million range, and your focus completely shifts from building wealth to optimizing how it grows. At this level, small percentage improvements begin to make a massive difference. A mere 2% increase in your returns is no longer minor. It can mean an additional $5,000 to $20,000 every single year. You move far beyond basic asset allocation and begin deeply refining your strategy. You dynamically adjust your exposure across different asset classes based on risk, your time horizon, and changing market conditions. While equities still drive your core growth, you start adding more structure to your portfolio through fixed income, real estate, or alternative assets. Tax efficiency now becomes a major priority. You strategically place high-turnover investments inside tax-advantaged accounts while holding long-term growth assets in taxable accounts to minimize capital gains. You might also begin using advanced strategies like tax loss harvesting to actively offset your gains. Your entire evaluation process changes. Instead of asking, "How much money can I make?" you start asking, "What is the probability of loss, and how large could that loss be?" You evaluate every investment based on expected return versus downside risk. Because of this, diversification becomes highly intentional. You analyze how your assets behave during periods of severe market stress, not just during growth periods. At this stage, investing becomes less about making individual, sporadic decisions and more about maintaining a system that performs across all different economic environments. As your capital grows, avoiding major losses becomes just as vital as generating high returns. And once your capital reaches a point where your level of access begins to change, the exclusive opportunities available to you change right along with it. Level 5 is the high net worth investor. Your investable assets cross the $1 million threshold, and that number completely changes how the financial system treats you. You are no longer limited to public markets. New opportunities begin to surface. Not because the investments themselves have changed, but because your scale of capital now qualifies you to access them. You start participating in private investments, including private equity funds, venture capital deals, and real estate syndications. Because these are not traded on public exchanges, they are introduced through exclusive networks, specialized advisors, and financial institutions. The underlying structure here is entirely different. These opportunities require significantly larger minimums, longer holding periods, and reduced liquidity. Your capital may be locked up for 5 to 10 years, with returns distributed over time rather than immediately. In exchange for this illiquidity, the potential returns can be higher, but the risk increases as well. Your evaluation process shifts to analyzing deal structure, sponsor quality, and the expected internal rate of return. To manage this, you begin working alongside professionals such as private bankers, financial advisors, and tax specialists, not to replace your own decision-making, but to structure your entire portfolio more efficiently. Consequently, your portfolio becomes far more complex. While public equities remain important, they are no longer your only source of returns. You deliberately allocate capital across multiple strategies with highly specific roles, balancing aggressive growth, consistent income generation, and capital preservation. At this elite level, the core challenge is no longer about gaining access. It is about selection. Once your capital reaches this scale, opportunities don't need to be found. They are actively presented to you. As your wealth continues to scale, investing stops being an occasional activity and becomes your primary focus. Level 6 is the professional investor. Your capital crosses into the $10 million to $100 million range, and investing is no longer a side activity. It becomes your primary function. Your portfolio is now so massive that performance matters in absolute terms. A 5% return is no longer just a percentage. It represents $500,000 to $5 million in annual gains or losses. Every single decision carries immense weight. Because of this scale, you begin managing your investments much more actively. This does not mean frequent trading, but rather highly structured decision-making. You evaluate every opportunity strictly based on expected return, downside risk, liquidity, and time horizon. Your portfolio is deliberately diversified across multiple asset classes with each allocation serving a distinct purpose. Public equities for core growth, private equity for long-term upside, real estate for income and appreciation, and fixed income for stability. At this stage, you may begin running your capital within a formal structure, such as a family office or a dedicated investment entity. This allows you to manage taxes, regulatory reporting, and asset allocations with maximum efficiency. Performance becomes highly measurable. You constantly benchmark your returns against indexes like the S&P 500 and strictly track the internal rate of return across all private investments to ensure your capital is being deployed effectively. At this level, long-term consistency matters far more than individual wins. Avoiding major losses becomes your top priority because large drawdowns are incredibly difficult to recover from at this scale. Ultimately, your identity shifts completely. You are no longer just an individual investor. You operate like a seasoned portfolio manager. As your capital continues to expand, your decisions begin to extend far beyond your own portfolio, actively influencing where money flows in the broader market. Level 7 is the institutional investor. Your capital moves entirely beyond a personal scale, allocating hundreds of millions to billions of dollars through a fund, a massive family office, or an institutional structure. At this level, you are no longer just managing wealth. You are actively directing where massive amounts of global capital are deployed. You stop focusing on individual securities and instead focus strictly on macroeconomic allocation decisions. How much capital goes into equities, how much into private markets, and how much into credit, real estate, or alternative strategies. You invest through top-tier managers just as much as you invest directly, placing capital into hedge funds, private equity firms, and venture capital funds. You evaluate these entities based on their long-term track record, core strategy, and alignment of incentives. Because of this, due diligence becomes absolutely critical. You rigorously review fund structures, fee arrangements, and underlying risk exposures before committing capital, as a single allocation can easily involve tens or hundreds of millions of dollars. At this scale, liquidity becomes a major strategic consideration. You cannot move capital quickly without significantly affecting market pricing or your own access. As a result, decisions are planned over quarters and sometimes even years. Your capital fundamentally begins to influence outcomes. Large allocations can support entire companies, emerging sectors, or specific investment strategies. When you commit your capital, other investors often follow your lead. You operate as part of an elite network consisting of other institutional investors, fund managers, and specialized advisors, where critical information flows through deep institutional relationships. At this final level, investing is no longer about selecting assets. It is about directing capital at scale. Once capital reaches this size, it does not just participate in the markets, it begins to shape them. And beyond this level, the scale becomes even more concentrated, where a single decision can move entire global markets on its own. Level 8 is the billionaire investor. Your net worth crosses the $1 billion mark, and scale completely changes everything. You are no longer thinking in terms of traditional portfolios. Instead, you are thinking entirely in terms of massive strategic positions. A typical investment is no longer just a few $1,000,000. It means hundreds of millions, sometimes billions, deployed into a single idea, company, or strategy. At this scale, your capital is large enough to buy actual ownership and control, rather than just passive shares. You participate in major corporate transactions, full acquisitions, large equity stakes, and strategic investments that directly influence how a company operates. While public markets remain relevant, they are no longer your primary arena. Private markets dominate your strategy through direct deals, exclusive co-investments, and large-scale capital placements negotiated entirely behind closed doors. Your financial decisions carry highly visible impact. The moment you take a position in a company, the broader market reacts. The moment you exit, it is instantly noticed. Because of this, liquidity is no longer a simple matter. Entering or exiting a position requires meticulous planning, precise timing, and deep coordination. You cannot move quickly without heavily affecting the asset's price, so you must move deliberately. Your network expands to the highest global tiers. You interact directly with other ultra-high net worth investors, institutional leaders, and executives running major global corporations. Opportunities at this level are rarely, if ever, public. They are uniquely structured, negotiated, and executed privately. At this ultimate scale, investing is no longer just about generating returns. It is about absolute influence, determining where global capital flows, which companies grow, and which entire industries expand. At this level, you are no longer reacting to the market. The market reacts to you, and your decisions begin to shape outcomes far beyond your own portfolio.